Yep.
Sally, can you see me?
Yes.
Something, yeah, but I can't see the slide now. Oh, there we go. Okay. Well, good morning, everyone, and thank you very much for joining us today. This is what we call our quarterly download, and this is the summary for Q2 2021. You know, over the last 14 months, I've probably had 1,000 conversations, and I think I've asked every question and heard every opinion. So if there's a question you want us to answer today or to attempt to answer, please just ask it. Any question is fine. And at the end, we're going to try and answer them as best we can. You know, Zoom has been incredible for business and for our industry and for our company. I think our company's reach has grown 50 times because of this medium. I mean, here we're going to talk to 100 or 200 people, you know, all at the same time. And it's become a very acceptable way to do a lot of the transactional work in real estate. We've done some pretty complex deals in the last 14 months, and we've dealt with people who I think in the normal course of time, we would have seen 5, 10 times during the process, but we have made it work during Zoom, and it's really quite extraordinary. But all that being said, I think many people have missed personal contact. I think we miss meeting our clients. And at the end of the day, brokerage is a relationship business, and we can't wait to get out there and start meeting our clients again. Sally, let it rip. We're excited to be back. We're going to be on stage in the fall of 2021. We're going to be talking about how you pivot your business to become an apartment developer and an affordable housing developer. This is going to be a live experience. It's going to be posh. We're going to spoil you, and you can find out how to register on our webpage. For those of you that can't join us in person, check out our virtual presentation and our early bird pricing. We're back live on stage. Well, for those of you that have been attending our seminars in the past, you now know that we have hired a new graphics guy. Okay, so anyways, look, we will give you more details on this event, but we think it's time for us to get out of the office and get back to work and get back to, you know, meeting people and talking about the topic of affordable housing and new apartment construction. So October 28th is what we're going to call the gala dinner, wine pairing and everything. Okay, I said we're going to spoil you. And then October 29th will be a session. We've only got room for 60 people, but there will be virtual tickets at the end. And I'll give you a little bit of detail as we go on. Okay, so let's talk about sort of what's been going on in the marketplace. I wanted to talk about buyer and seller sentiments. Okay, you know, buyer demand was strong before the shutdown, and it's strong now. In fact, in the apartment industry, buyer demand is always strong. That's just the way it is. It's the nature of our business, right? There's always more buyers and sellers. I don't think I can think of really any time that I've been in the business where that hasn't been the case. So let's talk today about the seller. And you know, the sellers have had, you know, apartment owners who own buildings for 20, 30, 40 years have had an incredible run. It's been an incredible bull market. What makes them want to still keep their building, right? After making really a lot of money, and suites have gone from $40,000 to, you know, $300,000-$400,000, right? So what makes them want to stay in the business? And I think that there are 4 things that you know, that long-term owner is thinking about, and they have to have. So number one, I think they have to have a vision for their building or their portfolio for the future, right? I mean, in a few decades, some of our high rises are going to be 100 years old, right? And so you need to have a vision for your portfolio, and the people that have a vision are going to stay in the business. The people that don't have a vision are going to exit. Second, I think you need to have staying power. Look, we've been through something strange in the last 14 months. Who knows what the future holds? But, and you know, there's a lot of CapEx work and things like that that you're going to have to do. So you need to have staying power, you know, in an uncertain world. Number three, I think you need to see technology the way it is. It's accelerating, and it's going to affect our industry. Artificial intelligence is going to dramatically change the way we do brokerage. I think just building systems and so on are going to change. And I think the fourth thing, and probably the most important thing, is you need to love the business. You know, this is a business that's probably not going to get easier, and I'll talk about that a little bit later on. But you have to have a love for the business. Now, we did a large transaction in this quarter, not the biggest one we've ever done, but we closed a $202 million deal. It's our largest transaction so far this year. That's a picture of Nick Obradovic, our broker who ran that deal. It was a 2-year process to get this complex family deal done. It was 485 units, 4 shopping centers, and 2 self-storage sites. But one of the things that we have specialized in the last number of years is intergenerational families, and how we facilitate the transfer from the second to the third generation. First to second sort of seems to go okay. Second to third is difficult, and we developed some expertise. We've written a white paper on intergenerational real estate between the second and third generation. So just an update on new apartment construction. New apartment construction seems almost, you know, unstoppable. There have been record new apartment construction permits and sites under construction in the US and in Canada as well. But the one caution we have is that, you know, that the spreads may be narrowing between the, you know, development yield and the exit yield due to increased construction costs. So while there might have been more give before, you know, in that spread, I think rising construction costs are going to narrow that. So you want to make sure. I mean, you always want to make sure that your projected rents are solid. But I think that's even more important now with the spread shrinking because of increased apartment costs. The other thing that we've noticed is that, and this is a US trend, and there's data there, is that apartments are getting larger. One trend we've seen in new apartment construction, especially in the US, that apartments are getting larger, and I'm going to say about 5 to 10% larger. And you can see in the text there that 1, 2, and 3 bedroom apartments, on average, in about half the cities in the US, are 28 square feet, 39 square feet, and 100 square feet larger than they were previously. Now, whether that's a COVID impact, I don't know. Whether it's the fact that maybe there's more suburban development than there is downtown, you know, in the last little bit, but it looks like apartments are getting larger. And let's talk about that. Let's talk about that apartment size right now and its impact on development. So this is a chart that we often use because when we do feasibility studies, we answer the question of what size apartment should you build? Well, that's very specific to, you know, your area, right, and your resident profile. But let me describe it for you. On the vertical axis, on the left-hand side, is your rent per square foot. Sally, just move the cursor there, right? So I haven't put numbers on here because I'm trying to make a principle, right, or make a point without numbers here. So that's your rent per square foot on the left-hand side vertical axis. On the right-hand side vertical axis is your construction cost. That's your construction cost per net rentable square foot. Okay, and on the horizontal axis is your unit size. So that can be 0 to 2,400 square feet. Okay. Now, let's follow the blue line, and the blue line represents rent. So you know that when you have a smaller apartment, your rent per square foot is higher, right? And as that apartment gets larger, then that price per square foot drops. Okay, but and that happens. But then something interesting happens in the right neighborhood, in the right area, is that most people don't build very large apartments, right? If you build 14, 15, 1600 square foot apartments, 1200 square foot apartments, there aren't a lot of them. We've seen in affluent areas, we've seen that the price per square foot actually starts rising. So as the apartment gets larger, because there's such a short supply, where there's an affluent renter profile, you'll actually get a higher price per square foot on a large unit. Really quite a surprising phenomenon, right? Okay, so that's the first trend, is that apartments are not a straight line going down. It's a little bit U-shaped and there's a tail on it at the end. Now, let's follow the red line down. And now you're on the right-hand side axis. This is construction cost per net rentable foot. And it makes sense, right? As the apartment gets larger, the price per square foot goes down. Because if you build a 1,000 square foot apartment for $100,000, then a 2,000 square foot apartment isn't going to cost you $200,000. It might cost you $160,000, $170,000, because still only one kitchen, two bathrooms, and you're blowing up the apartment building, right? And you're increasing some costs, but all your core costs, your HVAC and things like that, stay close to the same. So when you superimpose these two numbers on top of each other, you see two sweet spots. So the sweet spot is the small apartment, right? So you've got, a high rent and the construction cost is below it. But the other sweet spot that people don't think about as much, and it relates to that point about apartments getting larger. And I think if you build larger apartments, sometimes you can make more profit. Now, there are many factors that go in here, including the price of land. But there is, we think, a sweet spot where you build larger apartments in those affluent areas where rent per square foot goes up, okay? So you get a larger apartment, a better resident profile, maybe a more stable resident profile, but you also get more profit from building a larger apartment. So we are fans of larger apartments, where larger apartments work. Just so we have people on this call from across Canada, but we're seeing a lot of development applications going in at the cities. We track them. And these are large. Look at the size of some of these complexes: 736 units, 285, and 555 units. And I don't know, I'm personally surprised that people aren't building more smaller buildings. If you look at the province of Ontario, where we have about 22,000 apartment buildings, 6 units and more, 18,000 of them are under 50 units, right? Like, there's a lot of small buildings that got built in the 50s, the 60s, and the 70s, but in the renaissance we're having now, we're seeing very few small buildings being built. They're all large buildings being built by institutions. In fact, all these buildings are being built by large institutions and joint ventures. And a lot of apartments being built in joint venture because they are so capital intensive. All right, so we want to spend a little bit of time talking about cap rates today. And, cap rates, we just sort of treat it, we as brokers say, well, the cap rate is, 3% or 4% or something like that. But let's talk about what actually, goes on with cap rates and what makes them up. But before we first do that, let's do a little quiz. So this is where you gotta come online now, okay? Sally, let's run the first quiz, okay? Go ahead, Sally.
Okay, sure. So the first quiz is, where do you think cap rates are headed as we enter Q3 2021? Do you think they're going to go lower, which means the price per unit is going to go up? Or do you think they're going to go higher, which means the price per unit is going down? So I'm going to launch the polling now.
So you just need to respond to that and hit submit, and then we'll show you the results. You notice we didn't allow you to say cap rates are staying the same, because everybody would pick that, right? We want you to know, which would you think that cap rates are going lower and apartment prices are going to become more expensive, or are cap rates going higher, which means that the price per unit is going to come down?
Okay, we have a clear trend. 78% cap rates are going lower and price per unit is going up.
Yeah, and I think that's certainly how I voted. It certainly looks like things are going in the right direction, and the big thing affecting that is interest rates, right? Okay, so first pop quiz, good, thank you. Second one, Sally.
Okay, the second one is, do you think we're going to have a federal election in the fall? Yes or no?
All right, Sally.
Okay. Another clear trend, so 74%.
Yes. And I think that's generally the belief. I know when I'm talking to office leasing agents, they said they're getting lots of calls for, 6-week leases, because that's, about the length of, I think, a Canadian election. So if it's called in August, which is the rumor, that means we're going to have an election in the, in September this year. Be interesting. Okay, Sally?
Okay. And so then the final pop quiz that we have, or poll, do you believe that income tax rates in 2023 and beyond are going to be going down, or do you think income tax rates are going to be going up? Great. Just give you another couple seconds.
Okay.
Okay, we have a few brave souls believe it's going down. Most people believe it's going up.
Yeah, and that's something that you get almost unanimity on with the money that's been printed, the monies that's been spent. I think tax rates are going up. And income tax takes a big bite out of your profits when you sell an apartment building. And we suspect that bite is going to get bigger in the future. And that might actually be a reason for people to sell now, because while tax rates seem high, they're going to be higher in the future. And tax planning is complex. We do a lot of it, not ourselves, but anytime a client comes to us and says, I'm thinking of selling, the very first thing we have to look at is what is the after tax, what does he wind up with the money in his pocket? And there's a lot of planning you can do. And we think that that's just become, it's always been important, but it's going to become more important in the future in doing good, solid tax planning. Okay. So let's talk about a cap rate. We said we'd try and drill into this a little deeply today. So a cap rate has really three parts to it. Okay, so what affects capitalization rate change? Well, the first part, and people will get these slides, right? The first part is that it's called the risk-free return. Okay, so the risk-free return is essentially interest rate, right? So that becomes sort of the foundation of the cap rate. And right now, interest rates are low, so that's going to keep cap rates low, okay? The second part of it is called the risk premium. And here you're comparing apartments against other types of alternative investments. So if other investments are yielding high returns, like right now the stock market, Bitcoin, whatever, are yielding high returns, that puts upward pressure on cap rates because people will say, well, I can make more money somewhere else, right? So it sort of adds to the cap rate, takes the cap rate higher, makes apartments cheaper. And then the third factor is growth, and that's a minus. So if you think there's going to be strong growth, then that's going to, a lot of demand for apartments and things like that, that's going to push cap rates down. So it's the risk-free return plus the risk premium minus the growth. And those are things that investors consider when they are coming up with their cap rate for a project. Okay, so let's drill into that just a little bit deeper. So let's compare 2019 to 2021. Okay, we think of 2020 and the latter half of 2021. So the risk-free return, that's interest rate. So in 2019 it was good. I mean, interest rates were low. They've been low for a while, but they're even lower now in 2021. So that's better for that's better for cap rates, better for lower cap rates. Then the risk premium. I think that other asset classes today, the stock market and alternative investments and things like that are probably doing better. So that's going to push the cap rate up higher. So they were lower in 2019. We think that they are higher in 2021. And growth, I think growth was good in 2019. In 2021, it looks like growth is going to be good, but we live in a very uncertain world. So I would say that 2021 growth is good, but it's a little foggy. We're not exactly sure, what's going to go on in the future and what the economy is going to be like. So in 2019, I think cap rates were low, but I think in 2021, as most of you also thought, they are probably going to go lower. But there's no certainty there. There's still some fog in the marketplace. So overall, I think there's no certainty which cap rates are going to go. But I think most people believe that cap rates are going to drop. Because of interest rates, the cap rate is where it is. And what could make cap rates rise? Maybe it could be a slower economy, more uncertain growth, or maybe more product in the marketplace. And one of the things I'm noticing is that certain apartment owners, intergenerational, second and third family owners, have had a long, hard year. And we think more of those people are going to sell than in previous years, and that could bring more product into the marketplace, and that could push cap rates up. And also, as long as interest rates stay low, that's the main mover of cap rates. Okay, so let's look here at, and this is for all asset classes, not just apartments, but I think it's a point that we want to make, right? So and Sally just pointed at the point of the dark green line, right, is cap rates for all asset classes. It's not the number that matters, okay? And the light green line below it is the 10-year Government of Canada bond, right? And so what you want to look at is the spread between those two. You'll see in certain years that spread is 211 points and then 231 points. And in other years, if you see in 2011, it was 465 points, and now it's 409 points. That spread, the bigger the spread there is, I think the more uncertainty that there is in the marketplace. Okay, and so there's still uncertainty in the marketplace. If you look at the very bottom of the chart, you'll see that it has gone up a little bit here, right? And so the spread is a little bit lower than it was before. But as long as there's uncertainty in the marketplace, there will be that gap between cap rates and the 10-year bond. Let's say Toronto cap rates for apartments are probably in and around the 3% range. Okay. All right. So Sally, let's go on to the next one. So we have over the years run live seminars on new apartment construction, and they've been 1.5 to 2 day events. We're going to run our first session, live session, October 28th. There'll be a dinner, and October 29th there'll be a full session. We've added a couple of panels on affordable housing. We think that the affordable housing movement is going to increase, and it's going to increase dramatically across Canada and in America. It's driven by environmental, social, and governance. And I think it's, I don't think it's fair to call it flavor of the month, but I think that there is now interest from government, from pension funds, from industry, and from the public to see more affordable housing built. And it's a regional business. The province of British Columbia has different rules and practices in place than Ontario, than the East Coast, and so on. But we think that the federal government is going to pay much more attention to affordable housing. And we think that a lot more money is going to be put into this sector to encourage developers to build. The programs are hodgepodge right now. There's no consistency from municipality to municipality or province to province. But I think that there is a will here, and people are going to, the government at all three levels, I think, are moving towards creating a policy that's more cohesive, that will result in more developers building apartments. We did last month 5 series on affordable housing. I was actually surprised by the number of people that attended, and the returns from affordable housing can also be, I think, surprising to you, if you look at it. Okay, so Sally, next slide. So the experience, we've got early bird pricing before July 31st of $13.95 for the in-person and $9.95 for the for the live stream. If you can come to the in-person, it would be great. It's time to sort of get out there again and do business. A couple of other things, and Sally, then we're going to go to questions afterwards. Okay. We have over the shutdown, we've really developed a significant education platform. We were always in the education business, but not being able to get out of the office, and Zoom just being what it is has really allowed us to grow this part of the business. So on July 13th, we're going to do a session. This is free. How to hire, train, and compensate leasing professionals. Leasing's gotten harder. It's going to become more competitive. And so we're going to tell you how to hire, train, and how to pay rental agents. And then we have our Apartment Leasing University, which this is probably the 4th time we've run it since the shutdown. Sally, next slide, I think, has it in there, right? There's the topics, and you can go to our website and look at the details. These are taught on Zoom, and Zoom really allows to create a classroom environment where we can role play, put people in breakout rooms, do quizzes, do tests and things like that. It's not the same as everybody being together in a room and being trained, but it's a significant, I think, 70 or 80% of the experience that you would get live. I think Zoom is really going to change education, in the world. Over this 14-month period, we've written a number of books. This is a book that's coming out this late summer, early fall. It's called The Future Apartment Developer, a step-by-step guide to planning, designing, building, leasing, marketing, and selling. So it's the guide for developers. And we find that a lot of people now are pivoting from the asset class they were in to apartments. And if you can pre-order a copy today, we're going to send you a special gift, an advanced copy of the book. Okay. So Sally, okay, so let's go to this. So we'd like you to just maybe now, we've got some questions that we'd like to talk about, but if anybody has any specific questions about the apartment industry, really any topic at all would be, would be fine to chat about. Okay. Sally, if there any,
Sure.
coming? Yeah.
So Derek, the first question would be, what do you believe is the greatest threat to the apartment industry?
Well, apartments have historically been recession proof, right? To a large extent, right? Especially in a diversified, broader market. So, and then when we had COVID, apartments did really, really well. So apartments are both recession proof and virus proof, right? I think the greatest danger to our industry is regulation. And that is government interference in our business. Many provinces in Ontario, in Canada, have rent controls. Ontario and Quebec have had a long history of rent controls. So that's a threat to the business. And I think the world, Europe, Canada, America have moved left, and the left likes to regulate the apartment industry. So I think the greatest threat is regulation. And the way you fight regulation is by the industry being organized, right? And lobbying the government to make, good decisions for the overall health of the industry, not just short-term political decisions, for votes. And the second threat to the apartment industry is something called ESG. I mean, you've all heard of it by now: environmental, social, and governance. And again, apartments are going to, housing is a fundamental. Well, right now, housing is a right. The UN has said it's a right. The Canadian government has said housing is a right. So as soon as something becomes a right, it becomes a claim against the taxpayer. So I think there's going to be more regulation coming in the apartment industry. It could be in the form of, something related to climate change and having to make your apartments carbon neutral. I can't imagine what that would cost or how you do that, but all of a sudden you could start getting regulation to do that. And that would be very, very expensive, right? And then if on top of that, you had some form of rent control or rent regulation, right, where you're forced to spend money, but yet you can't raise your rents, that might be a real challenge for us in the future. And certainly for those of you on the call from Ontario, we have had lots and lots of challenges with rent control in the past.
Thanks, Derek. Okay, another question. You said there's a shortage of apartments to sell in the marketplace, and cap rates are low. So why aren't owners selling?
Prices are at extraordinary highs, right? And you would think that some people would take this opportunity to exit, especially, Gen 2 who are now in their 60s and maybe their 70s, and Gen 3 is not interested in the business. Here are the three reasons that I hear people say that they don't want to sell. Number one is they don't want to pay the tax. And so apartment values have gone up significantly, right? So there's the capital gain component, and then they've depreciated the buildings, down to zero. So there's the recapture. And so that's the number one reason, Sally, I think, is that people don't want to pay the tax. But what I would say to them is, if you're going to pay a lot, if you think you're going to pay a lot of tax today, and 94% of you said taxes are going to go up, imagine how much taxes you're going to pay in the future, right? And we could see, and if they changed the capital gains exemption from 50% to 75%, or if even the tax on ordinary income went from 43% to 53%, that would wipe out a lot of gains that you might get in growing rents or in compressing cap rates, right? So tax is the biggest bite out of your profit, and it looks like taxes are going to go up. So that's the first reason. The second is they believe that prices will continue to go up, and quite frankly, for the last 20 years, they've been right. I mean, every broker has run around saying, it's the top of the market. So nobody knows when it's the top of the market, right? But I think that if you believe prices are going to go up, then you have to believe that interest rates are going to stay low for a long time, because that's what's keeping cap rates low, is interest rates. And I think the third one, probably the most interesting one, is they don't know what to do with the money. And that's really quite interesting, because you're going to get, 50 or $100 million. I don't know what to do with the money. And, but when you look at the returns apartment owners are going to get, so I'm talking here about a family. So the building was built in the 60s by the grandfather, the father's taken over, and now the grandkids are maybe taking over the business. If you take a look at the value, and most of these buildings are paid off. If you take a look at the value of the building today, let's say it's $100 million for the portfolio, they're typically only getting about $2 million in cash flow, because they're spending the money back. They're spending money back in the building as CapEx work. So they're getting a 2% return on their money. And if you sold the building and paid your tax and could get a 3.5 or 4% return, you could have your cake and eat it too. You could have your liquidity and have your money and get the same amount of cash flow from it. So, but a lot of people have a challenge as to, what do I do with the money? We should all have that problem. Yes.
Thanks, Derek. Here's a question. What do you think is the outlook or demand for single family rental homes?
Well, we keep hearing, more and more about this thing called SFR, single family rental, and BFR. Okay. And I think it's more of an American phenomenon, but anytime you see a trend occurring in America, start thinking about, could that trend occur in Canada? Right. And so SFR and BFR, build for rent. What it means is that a developer will take 50 houses in a subdivision, contiguous, right, and build 50 houses and rent them out. Okay. And the idea is that forms sort of an apartment building, stacked on top, not stacked on top of each other. And that there's a certain percentage of people who want to rent houses, who are going to temporarily or for the long term want to live in a house, but it be a rental, right? I mean, it's difficult, I think, to make it work in today's housing market, where housing prices are so high. But certainly if there's a downturn, or if a developer is caught with, subdivision and land, and he's got building skills, then I think, he could go ahead and build 50 houses, and you wouldn't have the same variety of houses, you wouldn't have the same, features and so on. There would be more standard. But there's I think there's a good case to make for BFR and SFR, and we'll just see how that trend continues in America and if it comes to Canada.
Awesome, thank you. Okay, this comes from Brian. What types of ancillary income should be pursued with a new A-class property? So anything outside of rent, Derek?
Yeah, so, that's income other than rent.
Yes.
Right? Income other than rent. And for a while, there was a real a trend going on, believing that your customer who bought apartments from you, or bought time in your apartments, you could also sell other services to, right? And so it's kind of a difficult question to answer. I mean, there's typically what makes up the bulk of it is late fees, pet rent, parking and tenant income and things like that. Something comes from storage lockers and things like that. I haven't seen that business really flourish the way people predicted it would, right? And that the idea is you've got this captive audience in your building, and you have all their data. You could start selling stuff to them, right? But I don't see that as being a significant number, Sally, anyway. I wish I had a better answer to that.
Thank you. Okay, this comes from Greg. I did answer it a little bit, but let's see what you say. Well, what is a good source for comparable rental data?
A good source of comparable rental data?
Yeah, where do you go for comps?
The most important thing, and Sally, you know this better than I do because you do that work, right, all the time. But I just think that if I were giving advice to a developer, you can read all the reports you want by feasibility study people like us, and by appraisers and by comps and things like that. But the rubber doesn't hit the road till you go visit the building, right? You just look at price per square foot and you go, it's $3 per square foot, but you've really got to go visit the key competitors, in your neighborhood. And then I think and that oftentimes will give the developer the confidence to believe the number that we give them. Sally, so many of our customers are first-time apartment developers. They are, in fact, the majority of our clients are first-time apartment developers. They're pivoting to building apartments, right? and they know other asset classes really well, but they don't know apartments. So when we come to them and say it's $3 per square foot, that's just a number on a page, right? But when you go out and look at the current competitor that's $290 per square foot, you go, oh my gosh, my building's gonna be so much better than that. Then you're gonna get the confidence in doing that, right? But so to answer the question, so in some areas now there's a significant amount of new construction. You can go and look at those buildings. In areas where there's not a lot of new apartment construction, you're forced to look at condo rental rates, and then that's not a perfect comparison. And then when there's not that, then you've got to go and look at older buildings that have been fully repositioned, right? And use that as a base and then add to it. Okay, setting rents is a bit of an art as well as a science.
Okay, thank you. This comes from Jacqueline Chan. What kind of amenities should be included in a new purpose-built rental?
I think that the ones that, I think the obvious ones is you need to have a great fitness center, right? Especially if you've got a younger audience, you need to have a really good fitness center. And a lot of times amenities are the cost of the amenities amortized over the size of the building, right? So a larger building can afford more amenities because the gym doesn't have to be twice as large in a 100-unit building as a 200-unit building, right? So, the obvious stuff, I think, you need to have social activity rooms. You need to have a great fitness center. I think the things that are sometimes missed still are either front of the house or back of the house space for storage lockers, for package delivery from Amazon and so on, right? I'm still surprised to see that people don't take that into consideration, and that's a key thing for people. In smaller buildings, the challenge on amenities is you just can't afford to put them in. So for example, if you can't build, great social rooms, then I would suggest you do a lobby lounge. So there's a lounge off the lobby. It makes the lobby look bigger. And for certain events, you can rope it off or close it off. And so use sort of multiple spaces, right, that have multiple uses or flex uses is important. Pets are a significant part in the building. You'll find that in newer buildings, 50%, maybe more of the people will have pets. So you need to have a pet facility and walking runs and things like that.
Okay, thank you. That was very concise. Next question, more brokerage related. What is your view on acquiring C-class properties in Ontario and then repositioning them?
I think it's a great business, and people have made a lot of money in doing that, especially well-located C-class buildings that you are buying off, intergenerational owners who had kind of set it and forget it. They were just, the buildings were cash flowing, they were taking the money out of the building, right? Couple of points to make here. Don't overlook the intensification value of the land. We had in Ontario so many towers in the park built, right? And so if you can buy a building that has excess land or buy two buildings side by side and the combination of land from two allows for intensification, that's valuable. I think that, you can never make an 8-foot ceiling higher. You can never add central air to a building, right? You can never really add balconies and things like that. So look for buildings that are, with larger units with balconies. Those probably reposition better. The danger to buying C-class buildings, let's say in good areas, is that we have something, that's an Ontario question, called vacancy decontrol. And so you buy a building and it's got maybe, half the units are being charged a below market rent. When that tenant moves out, you now go in, fix that unit up, and you can charge a much higher rent, right? So if you can raise the rent by $400, you might increase the value of that unit by $100,000. And you might only spend $30,000 to renovate that unit. So there's a big delta there. The danger is that if the government changes the vacancy decontrol laws or tenants don't move, then you don't get the opportunity to pick up that latent value, okay? And what we're seeing, so first, it's a good idea, okay? And it's a way you can add value to a building as opposed to when you buy a brand new building, there's not a lot of upside. You basically buy and hold it and, you get the cash flow you get from, year 1 to year 2 and year 3. If you buy that C-class building on turnover, you can reposition those units and dramatically raise the rent. And, you keep doing that every year as more and more people move out. The problem is that during the last few years, turnover has gone down dramatically, whereas 10, 15 years ago, it wasn't unusual to see buildings with 25 or 30% turnover. Now it's not unusual to see half that, okay? 12% or 10% turnover, and sometimes I've seen it lower. So if the people aren't moving, then you're not going to be able to reposition the building. But if they are moving, then you can. I would say that a C-class building full of students, they're going to move every 3 or 4 years. They're going to move, so you're going to get a chance to go renovate that building. But a C-class building full of long-term residents who've been there for a long time, they're probably going to be there for a long time again.
Okay, perfect.
So,
I think final 2 questions. Where do you see the opportunities? Where are the opportunities?
Well, I think one of the opportunities is in Alberta. I think cap rates are still higher there. There's good product for sale. So I think that might be an opportunity. We're selling right now a new building in Calgary, and we've had good interest in it. I think it's going to be in the 4.25 range, maybe 4.5 cap rate range. And you wouldn't get that in Ontario for sure. Okay. I think technology is going to allow for some really clever things to be done in buildings. And so I think apartment owners are going to, we've dealt with, sub-metering and things like that, but more is going to come in the future. Affordable housing, I think, is going to be something that's going to become more important. And, affordable, just when you say the word affordable housing, I don't know, it kind of implies, metro housing, city-owned housing, and things like that. Think of affordable housing as workforce housing. You create housing a little below, the market rent. Maybe it's 10% or 20% below the market rent. The different levels of government will give you various incentives to build that product. And I think you can put less money into the deal, and so your returns are better because you're putting less money in. And so I think affordable housing is certainly an area that people should pay attention to. It's an area that we're spending a lot of time on. And then I mentioned earlier, SFR and BFR would also be kind of interesting things to to keep your eye on and see if they sort of catch hold in Canada.
Okay, one final question from the audience. We have price per unit is still being used, I guess, as a metric for assessing deals. Yeah. Often when income doesn't really matter. So if there's intensification potential or a good location. Yeah. Should buyers stay away from crazy price per unit asking prices given the current risks?
Yeah, I think that's a really good question. I think price per unit is a terrible metric. Okay, because look, if I'm selling one building of all bachelors and I'm selling one building of all 3 bedrooms, you can't say what's the price per unit of those buildings and use it as a comparable, right? So you want to use cap rate, you want to use IRR, you want to use price per foot, right? Price per net rentable foot. What are you buying the building at? You're buying it at $200 and replacement cost is $400. There's implied value there. Price per unit is, I'll tell you where it shows up in our business. We'll sell a building. Well, I can actually show you one. This building right here. This is a building in Oakville. We sold it for the $577,000 per unit. At the time, I think was one of the highest, price per unit sales. But the units were 960 square feet. The building was extraordinary, right? So if those are all little matchbox, little 500 square foot units, 577 would have been an extraordinary price, but these were 900 square feet on average. So I think price per unit is not a good metric. It's probably the worst metric to use. And if I were, it's not the right metric to use.
Okay, I think that's it.
Fair enough. Okay, great. Okay, well, thank you everybody for joining us. We've hit the 45-minute mark, and we don't like realtors who push price per unit either. Okay, you should be looking at the fundamentals, of the business, not necessarily that. But thanks for joining us. We do this every quarter, and we'll see you sometime in the fall.
Okay, thanks everybody.